some basic idea about how these formulas can be calculated and how we can distinguish them. Now moving on to the next part, that is, as we discussed earlier in the previous class, that in this course, the one segment is to focus on investing decisions. And in investing decisions, we need to find out the value of any investment plan. As we discussed earlier, that there are different techniques or investment appraisal techniques, more precisely, in order to, find out or evaluate the profitability or feasibility of any project or anything, which you have already discussed, and it was explained to you earlier in the prerequisite in accounting for finance for managers. Okay, so just giving you the idea that while valuing these stocks and bonds or to evaluate the profitability or feasibility of any project, the three main topics what you had discussed earlier, that is stock valuation, bond valuation, and capital budgeting techniques. Okay, so we'll give you a quick review of stock and bond valuation first, then we'll move on to capital budgeting, and then we will start basically the course we are going to discuss, that is financial strategy and policy, right? So, you know that capital is one of the important segment of balance sheet, and the capital contains two important components. In your capital structure, there are two important ingredients. One is the debt and other is the equity. In debts, usually we can demark the debt with the equity, that debts are redeemable. And equities are non-redeemable. Right? The debts are redeemable, that is, after a specific period of time, you have to pay it off. This is obligated that you have borrowed certain amount of money, whether you have borrowed from any financial institution or any thrift institution or from any business angel or venture capitalist, or say the firm has issued some corporate bond. So whatever it is, there must be a maturity period. Like you have to pay it off after a specific period of time. So because it is one of your liability which you need to pay, which is obligated to pay, which is obligated to honor the promise to pay back, that is why it is called redeemable. Whereas the other part, equity, is non-redeemable because it is not for a specific period of time. The person or the individuals or group of individuals has invested this amount of money, not for a specific period of time. There is no maturity period. So in case of any redeemable instrument, we have a maturity period. Right? And usually, whatever the amount that is earned with the investor's perspective, or it is the amount of interest. So there is a fixed rate of return, and you can call it interest in simple words. Right? So there is a fixed rate of return that is commonly known as interest. There must be a maturity period because they are redeemable. Clear? On the other hand, when we are going to talk about equity, they are non-redeemable, no maturity period. And usually it could be variable returns. But we need to discuss this variable return in case of preferred stocks. So we'll discuss it later. So these debts are classified further as coupon bonds and zero coupon bonds. Right? So the first thing what we are going to start or to discuss is we are discussing which carries a fixed or a coupon rate. It must have a maturity period because they are redeemable in nature, right? So let's discuss first the coupon bonds. Like in case of coupon bonds, you can it's not, I'm just explaining you, it's not like this. Just to explain you well, I am drawing a corporate bond over here, an IOU over here. But that doesn't stand for that. This is basically the picture of the bond. Okay, and there must be a face value. Let's say the face value is 1,000, right? Then we have a coupon rate. Let's say that is 10%, right? And a maturity period. And a maturity period. Let's say 5 years. Okay. Then we have some coupons over here. Okay. That is 1, 2, 3, 4, 5. These are the 5 coupons, right? And it is compounded annually, right? And these are the 5 leaves on the bond. As I told you earlier that this is not the real picture of the bond, just to explain you its functional attribute. Explaining it to you, like these are the 5 coupon bonds. Keep in mind that the coupon rate will always apply on the face value or the future value of the extrinsic value of the bond. So you can call it the face value, you can call it the future value, or you can call it the extrinsic value, what is mentioned on this bond. Like you will be entitled $1,000 after 5 years at its maturity. So after 5 years, this bond is going to mature, and the company is bound to pay you back $1,000 at its maturity. Clear? During this time, the company is promising to pay you a 10% return, a 10% coupon rate, a 10% interest on this 1,000. So 10% of this 1,000 is 100. So there are 5 leaves of $100 each. Clear? So every year, by the end of every year, you are going to take out 1 leaf from this bond and in cash, and the company is bound to pay you $100 every year at the end of every year. So first year you will get 100, second year you will get 100, third year you will get 100, fourth year you will get 100, and fifth year not only you will get 100 but you will get $1,000 as well, because the bond is going to mature in 5 years time period. Clear? Okay. Now the question is that if a bond is going to offer you a 10% coupon rate, which will, I told you, apply on the face value, that is $100 every month. So this bond is going to give you altogether $1,500. 100 every year for 5 years, and at the end of 5th year, you will get 1,000. Right? So altogether, the total quantity of money you will receive after investing in this bond is $1,500. Right? So my question is that at what price you should purchase this bond today? You will get 100 after 1 year, another 100 after 2 years, then 100 after 3 years, then 100 fourth year, fifth year, and at the end of fifth year you will get 1000. So altogether the total amount of money or the total future cash inflow you will receive after investing in this instrument is $1,500. So at what price you should buy this bond today? Right? So I am offering you a bond which will give you $1,500 altogether in 5 years time. So the question is, at what price, what should be the fair value according to you, that at what price you should buy this bond today? Right? Simple question, yeah. Come again? We should buy this bond at a price of $1,000 because it is the face value. Okay. Let's check this out. Now the issue is that the current discount rate in the economy is 12%, one thing. Or I am rephrasing it that how much return you want from your investment. Now I need your proper attention to understand the whole idea. What return you are expecting from your investment, right? Say for example, I am asking you that, brother, I need 1 million today for my startup business, what I am going to start. So, and you have that 1 million as your savings, and you want to channelize your savings into investment, and you are roaming around and wandering around that I should invest this 1 million today in some business. You know I am a trustworthy person, but still, at what return? Okay, I am offering you that invest 1 million in my business, right? Today, and every year I'll give you 5,000 rupees. Over the investment of 10 lakhs, I'll give you 5,000 rupees every year, and after 5 years you can take back your 1 million, right? Are you interested to invest in my business? No. Why not? Sir, 5,000 is very less. 5,000 is very less. You are offering me 0.5% of whatever the amount of money I am lending or whatever the amount of money I am investing. So this 0.5% is not feasible. Even 5% is not feasible if I am offering you 50,000 a year. And you are offering me 5,000 people. Okay. So now my counter question is, okay, so how much return you are expecting from your investment? 15%. Okay? So what's your name? Akbar. Akbar is interested to invest somewhere where at least he earns 15%. Right? Now my another question, please pay attention. Now my another question to Akbar is, okay, 15% is fine. I have no issue with that. But how you calculated that 15%? The other question I am going to ask, like, why 15? Why not 12? Why not 17? Why 15? So Akbar will give me a brief idea. Remember, we had discussed previous class the value of money depreciates over time, and there were 3 reasons which we had discussed earlier. So why Akbar is asking for 15% return at least every year. Okay? So let's break this up. The first thing Akbar is going to, explain that 15%, that look sir, currently our economy is facing inflationary surge, right? The value of money is depreciating very harshly, right? So one of the reasons why I am asking you 15% is the inflation, right? Okay. What else? The second reason could be that, sir, you know that State Bank of Pakistan has recently announced in its monetary policy, that is basically a condition imposed by the International Monetary Fund, to lend some more loan is 9.75%. That means State Bank of Pakistan is admitting or accepting that our money will depreciate at the rate of 9.75%. So if you are paying me 9,750 every year over an investment of 100,000, that means I'm gaining nothing, I'm losing nothing as per State Bank 9.75%, because they are accepting that our money is going to depreciate at the rate of 9.75% a year. That is the discount rate which is offered by the State Bank of Pakistan, right? So that means 9.75% तो State Bank का पेट भरने में, या दूसरे लफ्जों में जो है, जो State Bank कह रही है, अगर आप मुझे एक साल के बाद 1 लाख पर 9,750 रुपए दे रहे हैं, तो आप बिल्कुल को एहसान नहीं कर रहे। 9,750 तो वैसे ही रुपए की कदर में कमी वाकई हो रही है। The money is depreciating as per State Bank is 9.75%. तो अगर आपने मुझे 1 लाख लेकर आज से 1 साल बाद 1,09,750 रुपए दिए, तो इसका मतलब आपने मुझ पर कोई एहसान नहीं किया। 9,750 तो वैसे ही डेप्रिशिएट हो रहे हैं। जो चीज 1 लाख रुपए की आज है, वो 1 साल बाद 1,09,750 की हो जाएगी as per the instruction, as per the monetary policy of State Bank of Pakistan. सही है? मैं इन्वेस्ट क्यों करना चाहता हूँ? I am interested to invest because if I am going to put this 100,000 under my mattress, right? So I will lose the purchasing power after 1 year. This 100,000 will not be sufficient enough to purchase the same thing what I can purchase today. So immediately I have to invest it in the economy, in the business, so that I can protect it to depreciate, right? The second big reason why I am asking for something more, that I am anticipating that the inflation will be, the inflationary surge would be 4% in our economy in year 2023. So if I am going to invest for the upcoming year, so at least I need to compensate my money that I can, add up at least that much amount of money what is being inflated. Are you getting my point? That anticipated rate of inflation, what I am expecting in the coming future is at least 4%. So 4% से inflation होगी, सही है? और उस inflation से भी मुझे बचना है। मुझे अपने पैसों को inflation से भी बचाना है, inflationary surge से भी बचाना है। मेरी बात समझ में आ रही है? I got it. So his required rate of return is, we are calculating the required rate of return what is Akbar is expecting from its investment in the future is 9.75%, 0.975. Okay, 9.75% is the discount rate, right? Then another thing what he is asking for, that he want to compensate the inflation of the economy. So he is interested to invest because he want to protect this depreciation, that discount rate. The other thing, he want to compensate or protect his money, the inflationary surge. Now the inflation is 4% in the economy. Okay. And the third thing he is looking forward for, that I am taking a risk. I am taking a risk in investing in your business. Maybe you can go bankrupt or insolvent. You are a trustworthy person, but there are different catastrophic situation in the globe, possibly. So that is why I want to charge some risk premium in investing in your business, right? Because अगर आपने मुझे sort of 1.0975 into 1.04, 1.0975 into 1.04, minus 1 multiplied by 100, 14.14. So 14.14 is basically 14.14 is if you are even paying me 14.14% of my investment, still I am not getting anything. Please pay attention to this. Still I am not getting anything. 9.75% must be depreciated over time, and over that depreciation, the inflationary surge will be implemented at 4% in the upcoming future. So that means even if you are returning me 14.14%, I am at break even, you can say. I am at break even. यानी कि अगर मैंने 1 लाख उधार दिया और आपने मुझे रिटर्न में 1,14,140 रुपए वापस किए, तो वो 14,140 जो है इस इन्फ्लेशन को और स्टेट बैंक की मॉनेटरी पॉलिसी को कंपनसेट करने में काम आ जाएगा। यानी आज जो आप मुझे उससे 1 लाख दे रहे हैं और आज से 1 साल बाद अगर आपने मुझे 1,14,140 रुपए दिए, तो उतने ही अंडे आएंगे जितने 1 लाख रुपए के 1 साल पहले आ रहे थे। तो मुझे तो कोई फायदा नहीं हुआ सर। सिर्फ ये हुआ कि आई हैव प्रोटेक्टेड वेल my money to depreciate in the economy. That's it. अब जो मैं रिस्क ले रहा हूँ आपके कारोबार में पैसा लगा, so I should at least give me 1% risk premium. 1% तो आप मुझे रिटर्न देना सर, यानी जो मैं रिस्क ले रहा हूँ आपको। Okay, so add risk premium, right? Add risk premium. So 1.01, right? So now, Sadaf, can you calculate that? 15.15%. So look, that is why I am asking you 15.15% return at least, so that now I have protected my money with a discount rate. I have also covered the anticipated inflation, right? Because when I was giving you or lending or investing in your business, at that time the petrol was 100 rupees per liter, and now the petrol is 160 rupees per liter or 150 rupees per liter. Are you getting my point? So you know I have to compensate, na? Otherwise there is no point of investing. So at least if you are going to give me 15.15%, that is over 100,000, if you are going to pay me 1,15,150 rupees, then I have earned 1% only. Still, all you are giving me 15.15%, but I am only earning 1% return, because rest of the return that would be consumed in the economy. But she thinks that 1% required risk premium is not sufficient. At least I should get 3%. So if instead of 1.01, if you are going to multiply the this product by 1.03, you will get a different answer. You will get a different answer. Let's say 17%. Let's say 17.5%, right? So that means Akbar is happy to invest at the rate of 15.15%, but what's the name? Rehab. Rehab is interested to invest at least at the rate of 17.5%. What we have calculated here, required rate of return, 1 plus required rate of return, right? So if you are going to do this calculation, you will get 1.1515, right? Then plus 1 will shift over there, minus 1, and then multiply by 100, you will get 15.15%. Are you getting me? So if you want to calculate out the required rate of return, now it is very interesting, I need your attention. If you are interested to calculate out the required rate of return, right, it could be 15%, it could be 17.5%, maybe she is anticipating the inflation that Akbar has miscalculated the inflation is 4%, maybe the anticipated rate of inflation or inflationary surge should be 5%. So her required rate of return will be different than Rehab and Akbar. Are you getting my point? So the required rate of return will be subjective. Every investor will calculate its own required rate of return. मेरे साथ रहिएगा. हर इन्वेस्टर अपना रिक्वायर्ड रेट ऑफ रिटर्न कैलकुलेट करता है कि मुझे अपनी इन्वेस्टमेंट पर या अपनी लेंडिंग पर कितना रिटर्न चाहिए. सही है? Now the required rate of return, make it rounded off to 15% and rounded off to 17%. Right? So now calculate the value of the bond according to Akbar. Calculate the value of the bond according to Reha. Okay, so look, I am offering you 100 every year for 5 years. Last year I'll get 1100. And the rate of return of Akbar is 15%. So you will get the present value of the bond. Like if Akbar is expecting to get 100 every year, मेरे साथ रहिएगा. Akbar is expecting to get $100 every year from company ABC, right? For next 5 years, and at the maturity, he will be encashed 1,000. And his expected rate of return, his required rate of return is 15%. So according to him, the value of the bond would be $832. Okay. Look, please pay attention. अब जरा सुनिएगा. If Akbar buys, मेरे साथ रहेगा, interpretation important है. If Akbar buys this bond today at the price of 832, and he will be entitled 100 every year for next 5 years, and at the end of 5th year he is going to get 1,000. In that situation, he will earn 15% return of his investment. अगर आज अकबर 800 और 32 रुपए का ये बॉन्ड खरीदते हैं और अगले 5 सालों में इनको $1,500 मिलते हैं, 100 and 1100, that means he has earned exactly 15% return of his lending or investment, whatever you would like to call it, right? मेरी बात समझ में आ रही है? 832 according to Akbar, the fair value of the bond. What is it? The fair value of the bond, or the intrinsic value of the bond. According to Akbar, the intrinsic value of the bond is 832. But what about Reha? So change this 1.15 to 1.17, right? $776. Pay attention here. Okay. इसका मतलब अगर रेहा को sorry, if Reha wants to earn 17% return of her investment, so she should buy the same bond. What Akbar is purchasing at 832, she should buy this bond at a price of 776. Right? If she buys the bond at 776, she will exactly get 17% return. 9.75 will be consumed in discount rate, monetary policy, economy. 4% is for the inflation research, and she will get 3% risk premium of her investment. So collectively, she will earn 17% return. So her money will grow at the rate of 3%, at least the risk premium. Rest of the thing will be incurred by the economy. Right? So, one lender is calculating the intrinsic value or the fair value is 776 of the same bond, whereas the other investor is calculating or calculating its intrinsic value to 832. And if somewhere between you, who is interested to invest at the rate of 16%, right? So somewhere between 805 or 806 rupees, you should buy this bond and you will be returned 16%. Are you getting my point? So what I am trying to explain, okay, one thing that is, if this is a regular stream of cash, the coupon rate every year you are getting 100, 100, 100. So there is no change in the formula of present value of annuity and this formula. So that is why this is the formula of the present value of annuity, that is payment 1 minus 1 plus R power minus n divided by R. So this is the same formula what I have mentioned. Because this was, thank God it was for 5 years. What if it was for 35 years? So आपके इस लाइन को कितनी लंबी कर लेते हैं? तो इसके लिए आपके पास ये सिंपल फार्मूला, that is coupon 1 minus 1 plus R power minus n upon R, the same formula of the annuity. The face value I did it separately, I discounted it separately. Reason because this was a different amount, that is 1,000. So remember the formula. What we are doing throughout in the finance is the future value. This is future value I will get after 1 year. 1 plus R power n. So remember I told you that in the finance, if you understand this formula, most of your tasks will be done. So whenever you want to calculate out the present value of the bond or intrinsic value of any instrument, divide future value by 1 plus R power n. This R. Now this R is very important to understand. Here the R of Akbar was 15%, the R of Rehab was 17%. If State Bank is lending, sir, please pay attention. If State Bank is lending some amount of money to the commercial bank, their required rate of return is 9.75%. Right? If the banks, the commercial banks are lending internally to one another, so they will charge, say for example, 10.5%. So their required rate of return is 10.5%, right? If the commercial bank is lending money to public, they are charging, let's suppose, 12%. So their required rate of return is 12%, right? If Akbar is investing in my business, so he is ready to invest at the rate of 15%. Whereas the risk premium, what she is looking forward to, is 17%. So that means the required rate of return is variable. It varies from subject to subject. Are you getting my point?
Yes, sir. Yes, sir.
Okay. Now, he is looking forward for 15%, she is looking forward for 17%. Now, Akbar called the broker that I am interested to buy a coupon bond of ABC company. At what price it is being traded? So simple and easy. Akbar has already determined the intrinsic value of this bond is 832 if he requires 15%, right? Then he called the broker that I am interested to buy the bond of ABC company. At what price it is being traded today? If the broker says that this bond is being traded at a price of 800. This bond is being traded at the price of 800. So that means according to Akbar, it is undervalued. According to Akbar, it is undervalued. Why undervalued? Because according to him, to earn 15% exact return, even he buys this bond at a price of 832, still it is perfectly okay. But if you are getting it in the market at price below than its intrinsic value, so that means the return of Akbar would be 16% somewhere. Because 832 का खरीदने पर भी उसको 15% रिटर्न मिल रहा था, अगर 800 का मिल गया तो सस्ता है, it is undervalued, and his return would be 16% somewhere, right? And if the broker says it is 850, so it is overvalued, right? And he will not be entitled exactly 15% what he is looking for, maybe 14% or 14.2% or something. On the other hand, 800 is overvalued for Reha because she was interested to invest at 17%. If she buys this bond at the price of 800, it is relatively overvalued and she will only earn 16%, not 17%. Right? So now you may get the idea that there are many potential suppliers in the money market. मेरे साथ रहिएगा please. There are many potential suppliers in the money market, right? And they are interested to invest or provide the loanable fund at various rates. Akbar is interested at the rate of 15%, Rehab is interested to invest at the rate of 17%, AKD is interested to invest at a rate of 13% even, right? The commercial bank are interested to invest at 12%. So there are various interest rates at which various suppliers are ready to supply their loanable funds. So this is the supply of money in the money market, right? Right? And there must be many potential demanders. There are many potential demanders who are willing to demand money. They are seeking investment. They are seeking for loanable funds. They are looking to borrow money from the market, right? And at various interest rates. This is Haji Barkatullah, the heroin supplier. He is ready to borrow money at the rate of 30% even, because the risk premium in his business is very high, right? This is Gul Khan, who usually, kidnap kids and ask for ransom from the parents. His business is really very, risky. So the risk premium you could ask is 100%, 90%, 80%, right? Because the state bank monetary policy discount rate is fixed. The inflationary surge, what you are anticipating, it could be 4%, it could be 5%, it could be 4.5%. It cannot be hyperinflation immediately. In Ukraine, there is a possibility of hyperinflation. But in a normal and peaceful situation, the inflation will not surge to a very high peak immediately, at least. So there are various potential demanders who are demanding the loanable fund at various interest rates. There are various suppliers who are willing to supply their loanable fund at various interest rates, right? But we will not listen to Akbar, we will not listen to Rehan specifically. Collectively, we are listening to everyone. But in market is a mechanism, market is a situation, market is a process where potential demanders and potential suppliers synchronize with the mutual consent, right? So we are turning deaf ear to everyone. Like say for example, if I am going to ask you that at what price, please, 1 to 10, 1 to 10, ये वाली रो, 1 से लेकर 10 तक कोई भी नंबर आपने करना है एक साथ. जब मैं 1 to 3 कहूँ एक साथ आपने अपनी मर्जी का कोई भी नंबर बताना है 1 से लेकर 10 तक. तैयार है? ये वाली रो 1 2 3. एक साथ नहीं बोले, दोबारा बोले 1 2 3. सही है? किसी ने 7 बोला, किसी ने 4 बोला, किसी ने 3 बोला, मुझे कुछ भी सुनाई नहीं दिया. और वो भी आप तकल्लुफ से बोल रहे थे. अगर बड़ी आवाज में बोलते तो बिल्कुल ही कान बड़े आवाज सुनाई नहीं देती. So these are the potential demanders who are demanding this market at various prices. Here is the group of potential suppliers who are willing to supply these markers. Just call 1 to 10. 1 2 3 7 5 6 4, right? So this is market. So market is collectively listening to everyone, not to any individual. So wherever the potential demanders and potential suppliers synchronizes with the mutual consent, that is market, right? So that is the equilibrium quantity that would be demanded, and that would be the equilibrium price of that commodity or that product or that good or that service, right? So 15% has been determined by the market, right? So thank you very much. We don't need you, because what about those potential suppliers who are demanding above 15%? They will immediately vanish from the market. They will immediately vanish from the market because nobody is ready to borrow money at that high interest rate. There are many suppliers. There are many potential demanders who are willing to demand less than 15%. They will also manage. They won't get any investment or lending because when the market has determined 15%, so you are fooled to invest at 10%. Obviously not. So this is basically the market. But there were many people like Haji Barkatullah Abdul Khan who are even interested to invest, to borrow at a very higher rate as well, right? But like they got at 15%, right? And they are willing to demand even at 20%, 25% or 50%. So whatever this area, that is consumer surplus, and whatever this area, that is called producer surplus. There were suppliers who were willing to supply even at a lesser interest rate. Are you getting my point? But this is basically the 15%, which is determined by the market. So now, are we discount that at the rate of 15% or at the rate of 17%, the rate of 24%? Obviously, whatever is determined by the market. Are you getting my point? मार्केट में क्या प्राइस क्या रेट लागू आप नहीं चाहते हैं मुझे मेरी इन्वेस्टमेंट को 100% मिले लेकिन आपके जाने से कुछ नहीं होगा ठीक है exactly so if you want to calculate out the value of bond we have a very simple formula I can write this formula over here that is the present value of the bond is equals to the coupon amount 1 minus 1 plus r power minus n divided by r plus the face value upon 1 plus r power n. So this is the formula of the value of bond to calculate the value of the bond. This is the formula to calculate the value of the bond. The present value of the bond.